All right, let's talk about some of the biggest decisions a company can possibly make. We're talking billion-dollar decisions. In the world of finance, it's called capital budgeting, and it's all about how a company decides whether to, say, build a massive new factory or just scrap the whole idea. You get it right, you create incredible value. But if you get it wrong, well, you can destroy a company. So how do they actually make that call? Just to get your head around the kind of money we're talking about here, think about a giant like ExxonMobil. They budget for capital spending of over $30 billion a year. That is not buying a few new laptops for the office. That's building sprawling new facilities, launching entire product lines, moving into new countries. So how in the world do they, or any company for that matter, make sure that money is being put to good use? When you strip everything else away, every single one of these massive investment decisions boils down to this one simple question. Is this project going to be worth more than it cost us to build it? If the answer is yes, fantastic. You're creating value for your shareholders. If the answer is no, you're literally destroying it. The real challenge, of course, is having the right tools to find that answer before you spend a dime. Okay, so to figure this out, companies have a few tools in their toolbox. Let's start with the first one, the one that probably feels the most natural to all of us, the payback rule. You can think of this as the quick and dirty back-of-the-napkin test.
So, what's the payback period? Honestly, it's exactly what it sounds like. It just asks, how long is it going to take to make our initial investment back? That's it. If you lend a friend $100 and they promise to pay you $20 a week, your payback period is 5 weeks. See? Simple. It's not about profit, it's just about getting back to even.
Let's walk through a quick example. Let's say we spend $250 on a project, all right? After year one, we get $100 back. So we're still in the hole for $150, right? Then in year two, boom, we get a cash flow of $200. Now hold on, we don't need that whole $200 to break even. We just need that last $150. So how much of year two does that take? Well, you just take the $150 we need and divide it by the $200 we got that year. That's 3/4 or 0.75. So you add that to the one full year we already waited, and our payback period is 1.75 years. Pretty straightforward.
And that simplicity, well, that's its biggest selling point. It's easy to get your head around, and it does favor projects that give you your cash back fast. But, and this is a huge but, the downsides are critical. First, it completely ignores the time value of money, the idea that a dollar today is worth more than a dollar tomorrow. Second, some manager just has to pull a cutoff date out of thin air, like, we only accept projects with a payback of 2 years or less. But the biggest flaw? It totally ignores any money that comes in after the payback period. A project could become a literal cash printing machine in year 3, and the payback rule just plugs its ears and says, nope, don't care.
So clearly, the payback rule has some serious problems, which brings us to our second tool, and this one is way more popular in the real world, the internal rate of return, or IRR. Executives and managers absolutely love this one, but as we're about to see, it has a few dangerous traps of its own. Okay, I know the official definition is a bit of a mouthful. Don't let it scare you. The basic idea is actually pretty simple. The IRR just tells you the project's own built-in annual rate of return. Think of it like this. If this project were a savings account, what interest rate would it be paying you? So if a project's IRR is, say, 15%, and you only need to earn 10% for your investors, it sounds like a pretty great deal. And this right here is the secret to IRR's popularity. It just feels intuitive. We get percentages. Telling your boss, hey, this project has a 20% return, just lands better than saying this project has a net present value of $1.4 million. It's a simple number that's easy to compare and talk about. But here's where that beautiful simplicity starts to get you in trouble. Let's look at a classic corporate finance dilemma. You have two projects, but you can only pick one. They're what we call mutually exclusive. Maybe you've got one plot of land, and you can either build a small, highly efficient factory or a larger, more powerful one. You can't do both. So take a look. Investment A has a juicy 24% IRR. Investment B has a 21% IRR. Which one do you pick? I mean, everything in your brain is probably screaming Project A, right? Higher return has to be better. Always. Or is it? And here it is, the big reveal. This is IRR's fatal flaw. If our company says we need to make at least a 10% return on our money, look what happens. Project B, the one with the lower IRR, actually creates more value. It puts more money in our pocket. Its net present value is higher. This is the IRR trap. It tells you the rate of return, but it doesn't tell you anything about the scale, about how many actual dollars you'll end up with. So this brings us to our third and final tool, the one that finance professors and professionals all agree is the gold standard, net present value or NPV. The reason it's king is because it avoids all of these other traps by being designed to answer the one question that really truly matters.
The beautiful thing about NPV is that it cuts through all the noise. It doesn't give you a time frame, it doesn't give you a percentage. It gives you one thing, a cold, hard dollar amount. It tells you in today's money exactly how much richer this project is going to make the company. It is the bottom line, period. So how do we get to this magic number? Well, it's actually a pretty logical process. First, you have to forecast all the cash you think the project will generate in the future. Then, you discount those cash flows, which is really just a fancy way of acknowledging that a dollar you get next year is worth less than a dollar in your hand right now. Once you've pulled all that future money back to its value today, you just subtract what you paid to start the project. And whatever's left over, that's your NPV. All right, let's put this to the test. Let's imagine we want to get into the organic fertilizer business. It's going to cost us $30,000 up front. Our best guess is that it will bring in $6,000 a year for 8 years, and then at the very end, we can sell the old equipment for another $2,000. Because it's a bit of a risky business, we decide we need to earn at least a 15% return on our investment. So we take all those numbers, we run them through the NPV calculation, we discount all that future cash back to today, and we subtract our initial cost. And what pops out? We get this, a negative number, negative $2,422. What does that tell us? It tells us this project is a dud. It doesn't even clear our 15% hurdle. In fact, if we do this, we're basically lighting over $2,000 of our company's value on fire. And this right here is what makes the NPV rule so elegant and powerful. The decision is crystal clear. If the number is positive, you do the project. You're creating value. If the number is negative, you walk away. You'd be destroying value. There's no gray area, no arbitrary cutoff to argue about. It's just a simple green light or red light. So, after walking through these 3 tools, I think it's becoming pretty clear why NPV wears the crown in corporate finance. But let's really nail this down and put them side by side for a final showdown. I mean, just look at this. When you lay it all out, it's not even a fair fight. Does it consider the time value of money? Payback fails. Does it consider all the cash flows a project generates? Payback fails again. IRR is a huge step up. It gets those right. But as we saw, its decision rule can be incredibly misleading, and it just can't handle choosing between 2 projects reliably. MPV is the only one that gets a perfect score. It checks every single box. And really, this is the whole ballgame. At the end of the day, what is the fundamental job of a company's financial managers? It's to increase the value of the firm for its owners. And what does NPV do? It directly measures, in dollars and cents, exactly how much a project will increase the value of the entire company. No other tool gets to the heart of the matter so cleanly. But that leaves us with one final nagging question. If NPV is so perfect, so obviously the best, why is it that real sophisticated companies still use payback and IRR all the time? Well, the answer is that the real world is messy. An NPV calculation is only as good as the forecasts you feed into it. And those are just educated guesses. So smart managers use the other tools for backup. Payback gives them a quick gut check on risk. How long is our money tied up? And IRR is just a fantastic communication tool. So yes, NPV is the gold standard that gives the right answer. But sometimes when you're making a billion-dollar decision, you're going to want a second and even a third opinion.